Hello, everyone. James Dobson here, your friendly neighborhood realtor. I'm going to keep this one short because I don't want to be too doom and gloom or anything like that. I just want to report what I'm seeing out there and a little bit of commentary on what Alex puts out. All right, first things first, average price. We can see that we are heading basically straight down from the month before. It was expected. I mean, nothing has fundamentally changed. I think at a certain point, we're going to start to see the decrease in momentum or the declining momentum slow. So the rate at which things are declining will slow down unless we get a fundamental shift in inflation or interest rates. As it stands now, we've printed a slightly lower inflation number, which should be a good sign, which means that rate hiking should slow, stop, or potentially even reverse. But we'll see. All right, going down to changes in price, I want you to look at the second one here, average price. You can see we're still up 1% year over year, which is a silver lining, but we are down 19% from the peak, which is a little bit worse than last month. But again, you can see that the momentum is slowing a little bit. All right, and this just sort of further accentuates that point. Months of inventory is growing. So we're now entering that balanced market in terms of inventory. We might be headed towards a buyer's market, but I'm not sure if we'll get there. All this means is that there are more homes for sale, which is a good thing for buyers. And it's a generally good thing for affordability and a healthy real estate market. And then on the other side here, we have sales to new listings, meaning how many of the new listings are selling. So we have the inventory and then how much of the inventory is being taken out. So when we're up above 100 here, that means that our inventory pool is always shrinking. We're selling more listings than we're adding, right? But now we're down at 41%, meaning only 41%, 41 out of 100 listings will sell, new listings, which is why this inventory keeps growing, right? All right, next I'm going to skip these two. I'll put the link to this though, so if you want to read this whole article, be my guest, but I want to keep this one short and sweet. All right. The primary reason the market balance is weak is sales, which are the lowest in the last 17 years. So I thought this was a really interesting point to touch on, which is when you even take into account immigration and population growth, less real estate is selling now than, I don't want to say ever before, but in a long time, which is concerning. We have so many fewer transactions, which obviously not good for realtors, but fewer transactions just makes everything more competitive and much more aggressive, right? Because people are willing to go the extra mile because so few opportunities are presenting themselves. That's where you get into like non-conditional offers and stuff like that. So okay, you can see here, sales are declining. We are well below the 10-year average. I do expect this to pick back up again. I think a lot of it was a shock from the interest rates. And I was mentioning before, affordability. So we are now currently above the 1989 real estate bubble level of affordability, which was already way too high. And all this is doing is your mortgage payments on a typical property as a percent of median household income. So this is driven 100% by averages, and it's very generic. But it still accentuates the point that it's becoming more and more expensive to own real estate. And unfortunately, I think that is a trend that's going to continue. I think there are peaks and valleys in this, but the general trend is going to move towards less affordable real estate, meaning prices will continue to grow while your average income will still grow, but at a lower rate, right? Which just means that if your income is growing like this and then real estate prices are growing like that, the gap between them will continue to get bigger. And that's the trend that we've been seeing for the past 2 decades. Just because Canada is a very desirable place to live, which makes it a great investment. All right, labor markets. So a great point to sort of touch on here. What could cause prices to continue lower in an aggressive way, right? It would be a fundamental shift in the labor market, insolvencies, and forced selling. Luckily, forced selling these two don't really happen much, just because of the rules and regulations that we have in place here kind of prevents people from ever getting to that late a stage. There's usually intervention that will happen to prevent you from getting to that spot. Rise in insolvencies, same thing. I'm going to show you the graphs below, but it doesn't look like we're sort of getting out of control there. And then the labor market, we are at, all-time employment rates. So we could potentially see that as a peak. And then if people, a few years or last year was dubbed the Great Resignation, where people were historically quitting their jobs, and yet we're still at record low unemployment. And I think there's some kind of consolidation that needs to happen there in terms of these people who now might have to work again. We'll see. Obviously, I can't predict the labor market, but I think there's something to keep an eye on there. And if we are entering a recession, because I know the definition is being challenged now, there's a good chance that the labor market has already peaked, and we could see that fall a little bit, which would put further downward pressure on the real estate market. A lot of technical jargon there. I apologize. So you can see rise in insolvencies. This looked really bad to me, but then take a look at this. So this is a much longer chart. So you can see green is the actual bankruptcies, a peak in 2009. We've been on a very stable downtrend since then. However, the proposals have been on a strong uptrend since then. Not sure what to make of it, but apparently these proposals do not always go through, obviously. But like I said, we have a lot of regulation in Canada that prevents people from really ever getting to this stage. So I wouldn't be too worried about that. I'm going to skip on this. I'm going to jump right into rentals, and then we'll wrap things up quickly. All right, so rental market. We have average price for detached in green and condo in blue. Detached, you can see, has just gone bananas. Even during COVID, we saw no relief, and we are now at all-time highs. And I'll give you my forecast shortly. With condos, we have reclaimed the 2019 COVID high from around here and more. So that was around 2,500. We're now at around 2,750. Now, if we look at price valuations, we can see that we are at record highs for the valuations of these condos. Another interesting point to note on, from an investor's perspective, although rates are dropping, or rates are rising, and the price of real estate is dropping, rents are rising. Meaning if you're an all-cash real estate buyer, you're sort of in a sweet spot because the asset got cheaper and the income grew, right? Almost at an unsustainable pace though. So I do expect that we could see a little bit ease up on the valuation, so rent prices. The reason for that is as the rents get so hot and so competitive, more places start to come on the market just because of the opportunity, right? So we can see that inventory has grown slightly, and we are trending up in terms of active listings. Active listings and months of inventory are both growing, which is a great sign. Much needed relief. And of course, don't know what's going to happen in the future. But if you have any questions about this or you want to talk more, please don't hesitate to reach out. I love to talk about it. And I will include a link to this article in this email. Cheers.